Hey guys, Ken McElroy here. Great to be here with Russell Gray with the real estate guys, and we've known each other for a long, long time. I've been in a lot of their summits at sea and their goals and their syndication events and all those things. But one of the things I wanted to talk about today, because Russ is here with us, is about currency and currency devaluation. And we've had the opportunity to read The Creature from Jekyll Island with Edward Griffith. And if you haven't read that book, you should. I know I've studied it, you've studied it. So Russ, what should people be concerned about right now with what's happening with currency?
A lot, actually. I think that for people who don't study monetary history, what the old saying is, if you don't remember the past, you're doomed to repeat it. And the history of the world, there's been experiments with unbacked, what they call fiat currency, just printed money. And it's all good as long as people believe in it. And so in order to get governments to accept this paper that they print, they have created something called legal tender laws. So they have a tax code that says you have to pay us in our currency, and then the only currency that can be used for the payment of taxes and debt is our currency. So that creates demand for the currency and it gives it value. So that's kind of the way fiat currency works. So when the United States, for example, was founded, the Constitution spelled out that legal money would be gold and silver only, and there wouldn't be any paper. And so I won't bore you with the whole history, but in 1913 we created the Federal Reserve System. We didn't have a central bank. Well, we did have a couple of central banks. We always got rid of them. But we created today's Federal Reserve System. We created the IRS and the income tax. That all happened in 1913. Prior to that, the United States didn't have any of that. And so ever since the Federal Reserve was formed in 1913, the US dollar has steadily lost purchasing power over time. Today, if you talk to somebody that's talking about what something cost in the past, they say, and in today's dollars, that's this. Well, the reason they have to make that adjustment is because today's dollars are a lot less valuable than yesterday's dollars were, and that's a concept called inflation, and that's what happens when a currency goes down in value over time.
Great. Well, thank you. I think, what I remember from listening to you and Edward talk about this, and certainly Robert Kiyosaki, among others, and Peter Schiff, and some of the people who really study this. The one thing that I, just from a simpleton view is, well, as they continue to print, there's more of that in the system, therefore your money's worth less, right? I mean, so I remember looking at Mike Maloney did this Campbell's soup analogy where he was looking at the price of Campbell's soup. Because it's been around so long, you can kind of follow a price of Campbell's tomato soup, over a 40, 50-year period and see the price of it. And so is that what you're talking about? Is because that's a great way to look at purchasing power or loss of purchasing power on something that's been stable over that period of time.
Right, yeah, it takes more dollars to buy the same things. And so when you measure things in dollars, because the unit of measure is perverted, it loses value over time, it's hard for you to really judge if you're getting wealthy. I'll give you a real estate example. Most of us can relate to a real estate example. Let's say you have a 3-bedroom, 2-bath house on a little 5,000 square foot lot, and you bought it in 1960 and it cost you $50,000. And then you fast forward and you say, okay, and today it's worth $500,000. So you say, all right, so I have a $50,000 house that went up to $500,000. Am I richer? And the answer is, well, you're richer in dollars, but in terms of utility, the function a house serves, it still only sleeps 3 people. So you haven't gotten any richer in actual possessions. And this is where a dollar-based system that is filled with inflation can trick you into believing you're wealthy when you're not. You don't invest for those capital gains. You invest for the cash flow. You measure your wealth not in how many dollars I have, but how many doors. Every time we talk to you, you say, well, this is how many tenants I have. Well, that's because when you're investing in a property and you measure doors, it's how many tenants are in there going to work every day doing real work in whatever currency it is, at whatever currency value it is, and they're going to send you about 30% of their income. for living in your building. And so the question is, well, how many people do you want going out working for you, sending you 30% of their income? As many as I can have. If I just buy a house and it goes up from $50,000 to $1 million, I haven't really accumulated anything except dollars that continue to go down in value. So we want to acquire streams of cash flow a lot more than we just want to accumulate piles of cash.
Right. That's why we talk about cash flow versus capital gains, and I have some videos on that. One of the things that I wanted to chat about, I think that a lot of people don't pay attention to this, I watch this, is the wage growth versus inflation.
Right.
So I think what happens a lot of times is people, they're making more money. Like if you go back and look what people were making 10 years ago,
right.
Certainly it's more. They get these 2, 3, 4%, annual bumps or whatever from their employer. But if you look at what's happening with prices and money during that period of time, it doesn't appear that people are getting ahead. What do you think about that?
Well, that's exactly true. So you'll hear people talk about nominal or real. So when you talk about something in nominal terms, nominal like number, you say, okay, this person who was making $2,000 a month is now making $3,000 a month. So on a nominal basis, they're making more money. But if the cost of living that they were spending to pay for rent, to pay for health care, to pay for food, to pay for gas, to pay for clothing, to pay for education, if you look at all those things, they have gone up faster nominally than the wages have gone up nominally. So what happens is you've lost purchasing power. Even though nominally you're making more money, in real terms your standard of living is going down because the cost of living is going up faster than your income. And so the way it translates into real estate investing is if you take a look at your portfolio and you can see that the rents are going up 9% a year and wages are going up 5% a year, you can't count on real wage growth to drive your rents. You're going to have to find another way to bring value or bring a different demographic in that's earning more, because at some point the distance between what people can, it's costing them to live and what rent is costing them, at some point that gap is going to close to the point where they're like, I'm going to have to move to a less expensive place or a less expensive market.
Yeah. So we're seeing that now, like in markets like Austin. We're in Austin, Texas, some of our properties. And so the tenants, they come in and they fill out the application, and let's say they're making $50,000 and they're renting something for $1,000, let's say. Well, I just know that exact property, the rents are now $1,200 to $1,300 4 and 5 years later. And so per month, by the way. So, what you're looking at is a $2,400 to $3,600 increase in rent annually for that same person. And the question is, does that $50,000 tenant still make $50,000 in 4 years or 5 years later? And the answer is probably they make a little bit more, but not in the amount of rent, right?
Right. Well, I mean, you look at all the components of cost in somebody's cost of living. At the time we're making this, we're in a rising interest rate environment. Tenants carry debt, right? They've got student debt, they've got car loan debt, they've got credit card debt. And as the interest rates are going up, that takes money out of their discretionary money. When you've got cost of energy going up, they're proposing a 15-cent per gallon gas tax. Well, for a guy like you, Kenny, it doesn't matter. You're going to fill your car up. You're going to do whatever you want, because the amount of money it costs for you to support yourself versus the amount of money you make, you've got a lot of discretionary money. But for that person who's living, in a B-class property, has very little discretionary money, and all of a sudden the cost of health care is going up, and the cost of the interest rate is going up, and the cost of gas is going up. Pretty soon, that's impacting them. At the same time, rents have been going up.
Yeah.
And so they're being hit from all sides, and at some point, something has to give. Now, if you're, I think if you're in the right demographic, there's going to be people above who are feeling the squeeze that are going to move down into your property. And so where people, I think, are feeling it, and you tell me because you're in the space a lot more than me, but what I'm reading is that the folks that are in the upper end, they're the ones offering the concessions because they don't have anybody above them to come down, right? And they've overbuilt in that space, and so there's a lot of free rent going on in the A-class stuff, and maybe you tell me how that's affecting the B-class, but I would think it would be it would be a little bit helpful relative to being up there with those guys.
It's definitely been helpful in the B class. Of course, we're building A class and we have B class, so we're seeing it on all angles. I think what I wanted to point out to the people that are listening is that one of the things that we discuss, especially on the summit, and one of the things we teach is there are ways, because this can be pretty dismal, and there are ways to deal with this. And the way to deal with this is to invest or look for things that are inflation hedged.
Right.
You know what I mean?
Oh, absolutely.
And so that's really what this is all about. It's not to scare you. It's just to say, listen, this is what's happening. And so what are some things that people can do, even at a small level, to try to ride that inflation wave, and what are some other things?
Real estate is the perfect investment. It's the perfect investment for this environment. Most of the time when people are trying to invest for income, they're forced into buying bonds. And bonds are debt. And the challenge in an inflationary environment is that debt is not a good investment. You don't want to be the lender in an inflationary environment. You want to be a borrower. Well, guess what? You use a lot of debt to buy real estate, but the problem is, or the benefit is, that the tenant is actually making the payment. So when you go into debt, you're short the dollar, meaning that you're going to borrow future money to buy something today. That's number one. Number two, you're buying an asset, a physical asset, real estate, which is going to go up denominated in dollars, like that $50,000 house to the $500,000. It doesn't include increased number of doors, but it costs more dollars to buy that same property. So now you fix the debt, and you're short the dollar, and then you've got rising rents because of nominal wage growth and rising asset value prices because of inflation, and so you're in the perfect spot to hedge. I mean, there's no other investment that you can make that is as effective at hedging yourself against inflation as real estate. It is the best investment for an inflationary environment.
I completely agree, and the best thing is that you can get 60, 70, 80% of that money from a bank, which is basically other people's money, right?
Yep.
They're deposits by probably a lot of your friends. You can go get their money and use it to buy. The other thing is, on a very small level, we can invest in, gold and silver, right?
Sure.
Like you want to chat about that, because a lot of people don't have the money or the experience, or maybe they don't even have the passion to go invest in real estate. And that's a complicated subject, but on a small level, people can do small things, right?
Sure, absolutely. Obviously, you can buy a small property, and then eventually it becomes a big property. You started with a small property. Yeah. Specific to gold and silver, I don't really look at gold and silver as an investment, because an investment, by Robert Kiyosaki's definition, which I agree with, has to produce yield. It's got to produce income. So if I buy a piece of gold, it's just going to sit there. It's not going to produce income. It's like having a pile of dollars. So you look at it as an alternative to dollars as a place to store your savings. The difference is that as the dollar falls in value, it takes more of them to buy that same gold. So down the road, what you see is, again, let's go back in history, when the Federal Reserve System was formed, gold was $35 an ounce, and it stayed at $35 an ounce all the way up to about 1972 or 3. Right after Nixon took us off the gold standard in 1971, they devalued gold and brought it up to $42. Actually, it was $20.67 at the beginning. And then when FDR in the New Deal confiscated the gold, he repriced it at 35. And then it was 35 all the way up until the mid 70s or the early 70s. And then they repriced it twice to 38 something and then to 42. And it stayed at 42 for a while until it was released and allowed to free float. As soon as they did that, it went all the way up to 850. So all the people that had stored their wealth in dollars when gold was $42 lost a lot of purchasing power, because in the 70s, if you go back and look at the history, the dollar was in free fall. We had double-digit inflation in the United States. It took double-digit interest rates all the way up in the 20s to break it. But the people who bought gold went from $42 or $35 all the way up to $850. Well, gold didn't really go up. The dollar fell and gold protected you. So gold protects your long-term store of wealth, your long-term savings, by converting dollars that your properties are throwing off until you're ready to invest in something else. You park a chunk of it in gold. You park a chunk of it in dollars, and then when you're ready, you can sell the gold or sell the dollars, and put them as a down payment into a property, and then use debt and repeat that whole process.
Yeah, well, thank you. And so we're not really talking about whether you should invest in gold or silver or even buy it. What a little known fact in history is that Franklin Delano Roosevelt, FDR, actually made gold illegal to own.
Yep.
Right? In 1935, right here in this country. And because it was so long ago, people just don't remember that. Yeah. And there's a reason they did it, right? That's the interesting piece. And so everybody, I think now today is saying, well, that'll never happen to us. That's exactly what they said then. And if you're heavily in paper or stocks or anything like that, you're basically going to be wiped out, right?
Well, yeah, nobody's saying that the United States system is going to fall apart. I mean, it's a great economy. There's always going to be people. There's always going to be productivity. There's always going to be commerce. The currency could change. It's changed before. So prior to 1944, the world's reserve currency wasn't the US dollar like it is today. It was the British pound. And the British pound before that, I believe, I don't know if it was the French or Spanish, it was somebody else. But so countries come and go, currencies come and go, but the thing that remains constant is people. People are going to need to eat, sleep, they're going to need to consume goods, they're going to work and exchange the fruit of their labor for the things that they need, so there's always going to be commerce. I think what we're saying is that you want to be paying attention to what's going on and then hedge yourself, because you don't exactly know how these things are going to turn out. That's why we spend so much time hanging out with these smart folks, is trying to figure out where are things moving and how can we position ourselves to get as much advance notice as possible, and then when we get that notice, what do we do to account for several possible outcomes? I don't think it's a time to be afraid. I think it's a time to be aware and proactive.
I agree. And if you really want to understand what Russ is talking about, because he's clearly very, very educated on this subject, is go buy the book, The Creature from Jekyll Island. It's a great book. It'll kind of set your mind on, some of the things that have happened in the past. That's all we're trying to do here is let you know this, it's time to be aware and just to understand the bigger picture. So thanks again.